Okay, so let's talk about WIOA Funding 101, Part 1. So one thing we always get a question of is order of precedent. What rule applies when? You know, what trumps the other rule? What do we interpret? When something says something in the uniform guidance, something says in the regs, and then we got a table. What do we follow? So let's talk about that. So if you go through, the first thing we talk about is legislative statutes. You know, that's the law. The WIOA law was signed in 2014. Used to be, when I started, it was JTPA, then it became WIA, then it became WIOA over the years. And any other applicable federal statutes. You know, we issue statutes all the time that says this is the law and so forth. So that's the next step down. Then we have, every year, there's an appropriation. At any time, Congress can put a clause in an appropriation act that would apply to us. For example, one good example is the salary limitation. That's in legislation. Every year in the Appropriation Act, they put it into that saying there's a limit on salary that you can pay somebody with federal grants, right? So that was in 25, they brought it up, it's up to $225,000. How many of you are almost at that limit, pushing up against it? Anybody? Anybody? Half of it? Quarter of it? That's about it. That's a pretty high. When you think about grants, $225,000, that's a substantial amount of money. Then we have our implementing regulations. So that's the WIOA regulations, the various citations. The front, if you get a regulation book, you have the part that includes education and RSA and all the other partners, talks about that. Then there's the back part, talks about just the ETA specific regulations, right, for WIOA funding, right? So that comes next. Then we have executive orders, comes up. Executive orders, got to wear a seatbelt when you're driving a car. Drug-free workplace, no texting while you're driving, things like that, all those. You'll see those in the back in your boilerplate. There's a whole list of executive orders that and every year there's always 2 or 3 more. You know, it's like, oh, how do we enforce that? You know, after that comes OMB, the uniform guidance. So OMB is sort of down the list. It's regulations, all that are first statutes, and then it's OMB, right? We have 2 sites, 2 CFR 200, that applies to everybody, right? And then we have 2 CFR 2900, and that's strictly for DOL exceptions. In the old days when you had the circulars, and we had a lot of circulars, I don't want to go into it, I think there's a little handout that talks about what we used to have and now they're gone. But everybody had a different version. They called it the common rule, but everybody had a different version of the common rule. And OMB said that's gone. This is a rule for everybody. The only way you can have an exception is if it's in your appropriation or law that you must follow. For example, we have, in our law it says 10% admin. Also says no construction. Certain things. So we're allowed to have those exceptions at 2,900. And currently they're revising these right now because they're a little dated since OMB just revised the uniform guidance that came out, I want to say about 8-9 months ago. It's been revised. So they're going through the revision to see if some of these have to change, okay? So there's the regular for everybody, and then there's a couple extra. I think there's 21 exceptions in 2,900. Then we have ETA DOL directives. Those are training employment's guidance letters, TAGLs or TEGLs as we call them. There's unemployment insurance program letters that talk about specifically, here's a situation, here's how DOL's interpretation of that is, and so forth. And that's where if you read in the regulation, sometimes you'll read the secretary will issue guidance. The secretary will explain guidance later. That's what it means, and we have to issue a TEGL to explain what that means. So we've issued them on one-stop competition. We've issued them on certifying one-stop centers, things like that, to be more specific what we accept and what we consider that to be. After that, we have terms and conditions to your awards. So those are a couple of things that ETA, the grant officer, can add to these grant agreements. And you see those when you get your grant agreement, you have terms and conditions. That we incorporate a lot of the things like the salary limitation, but we'll say things like, you know, for program income, treat it this way. For certain conditions, you cannot buy this, or you can use the funds on this way. But so every grant, every type of grant, not just WIOA, but grants that ETA issues, we issue a lot of discretionary grants besides the formula program, may have different terms and conditions. So they're not standard across they're pretty standard, but there's exceptions when you have a unique grant, like a youth build grant, or an apprenticeship grant, things like that, or re-entry grant, things like that. They may have a different terms where it says you cannot spend money on this category, even though it's an allowable cost. We want the money spent specifically this way, right? So we got that? Everybody's good with that? Order, so if you have a question, you see something, you'd go through order of precedence and say, what applies? It says this in the uniform guidance, but it says this in ETA regulations. The ETA regulations trump the guidance, right? So it's straightforward. So there's no, in the past we used to say, you know, we had different cost principles for education, for nonprofits, for city governments and non-profit, you know, and everybody was like, well, it says this over here and it says that over here. Which one applies to us, right? So we've done away with all that. That's part of government trying to simplify your life. I'll let you know that, right? After that, let's talk about the WIOA formula, okay? Guidance provide, in the regulations, it tells you how the formulas are applied. So when they appropriate adult and youth and dislocated worker monies in the regulations and in the law, it says the parameters, the 3 parameters of each of these funding streams, how that's applied to allocate money to states, as well as then you take those same parameters and you use it to allocate within the state of Hawaii, how you allocate it to your local workforce areas, right? It's the same thing. The governor does have discretion in each of these 3 funding sources that they can change one of those factors. Each of these 3 funding streams has 3 factors. You know, usually it has civilian employment, how many people are unemployment rate, and then we'll have another factor. So they can change one factor unique to their state, and that's usually done in the state plan, the annual state plan. We'll be in there to specify why we're changing this factor and why it's important, right? Also, you know, the law says where the money goes to. You know, the law says 85% of adult money goes to the local area, 85% of the allocation goes to the youth, for youth, and in dislocated worker, 60% goes to dislocated worker, because the state can hold back up to 25% for rapid response, and then they have statewide dollars, right? So that's a distinction there. They can hold up to 25%. They don't have to. You know, 25 years ago, states had big rapid response units, people across their state, coordinators, because we had mass layoffs, we had a lot of manufacturing activity, all sorts of stuff, and they were dealing with rapid response all the time when you had layoffs. Those times have changed, I think. There's still big layoffs, but not as frequent. You know, I grew up in Michigan, in Chicago, sort of the Midwest. We had, when the economy turned, you know, the auto plants start laying off everybody, right? When things would turn, you had massive layoffs. Jobs were moving overseas at that time during the 80s, you know, moving plants overseas and so forth. So you had these big rapid response units. Now we don't have that. So the need, maybe, the state should think about, do we really need to hold back 25%? Can we push more money down to dislocated worker to the local funding streams, right? Because there's some flexibility there, okay? So, obligation authority, life of funds, right? States get 3 years to expend money. 1 year, they obligate, 2 years to expend, so they get 3 years. Local areas get 2 years. Obligate in 1 year, expend it by all at the end of the 2nd year, right? If not, that money comes back to the state for the 3rd year, and they have a year to spend it. So it's 1 + 2 or 1 + 1. Also in the regs, you know, we say FIFO, if you know what that means, first in, first out, an old accounting term. You don't hear that too often. But the regs, when you read the regs, it says use your oldest money first. So you want to use up your money. So we say you can always move costs back to use up those old money, but you can't move costs forward. For example, PY 25 has not started yet, right? It starts next week, right? You can't take costs now if you're overspent. You can't take money now and charge it to next week because you don't have authority yet, right? You can move it back, but you can't move it forward, okay? So let's talk about that. So when we give money out, DOL has a process, and sort of the state has a process, what we call recapture and reallotment. So at the end of the first year, DOL goes out and says, all our states, you have to obligate 80% of these 3 funding streams. It has to be obligated. Otherwise, we take it back. Because we give 85% to adult and youth, they're already above the 80%. They're at 85. The dislocated worker is at 60. So it's up to the state to obligate that extra 20% to get up to 80. Otherwise, the federal government will recapture that. Okay? And we don't recapture it in that year, we recapture it in the next year because 1 year is passed, so the obligational authority is lost in that first year. So we'll take it out of next year's dislocated worker funds at the state level. We'll take it from their statewide and admin dollars if we take money back. So we do that to states. The state also has a process where they go out and say, all of you at the local area have to be at 80% obligated. And if you're not at 80%, they take it from your funding streams. So even though we say 85 is obligated adult, that doesn't mean you've covered it. You have to then obligate 80% of those funds, right? Issue contracts, we know what an obligation is, and we'll talk about that. There's a training guidance letter on definitions. An obligation is a legal binding commitment to spend money, right? Could be a contract, could be a grant award, some kind of commitment that you have to, so you have to obligate 80% of those funds in the 3 funding sources, or they take it from you and they distribute it out to the other local areas, assuming they've met that 80%. So we never give it to anybody who hasn't met it. Anybody who's met that level, they get a little extra money, right? At the end of 2 years for you at the local level, you have to spend all the money. It's got to be expended. If not, the state takes it back from you and it becomes statewide activity monies to the state, and they have just that remaining year to expend it, right? Everybody good with that? Good. Because we're at that point, like now 6:30, the year's ending, you know, any unexpended money would come back to the state. So let's talk about some program limitations, right? So states withhold 15% from each funding stream. That's for statewide activities, they 10%, 5% for admin. They withhold that, right? Locals get 10% for admin, right? They withhold that. And you cannot exceed the admin limits. That's in the law. That's a max cap, cannot exceed that. In your book, just open up, in your book you have a little chart, that first colorful chart. We sort of walk through how money is spent. So you can see the PY and FY. It's a nice little graphic display, right? You can see when you start out, Congress gives you money, and then it comes to labor, then we run the numbers. You know, we publish those numbers. Here are the factors we use to allocate the money. There's conditions around that where there's a stop loss and a stop gain where because things change between year, you can't exceed too much and you can't lose too much. We cut you off if you don't lose more than 10% of your funds up to 90 at the back side. You can only get so much more on the front side, right? So everybody, we pack it in so that nobody has a big loss or drop off because the factors change. Because they do change a lot. For example, in dislocated worker, because they use the unemployment rate, that can change from year to year. Things can be real bad, things can be real good. It's a lag factor and so forth. So it can really impact the dislocated worker. That's where we see the biggest change in dislocated worker funding from year to year because that factor changes a lot. You can see the 3 funding streams, 15% and the 85%, and the reports that have to be filled out. And you can see in dislocated worker, there's sort of 3 categories. Keep in mind, you can transfer expenditures between adult and dislocated worker. You have a process, there's a state policy on that, that you let them, the governor know, I think you go through a process, but you can move the expenditures. You don't move the money on the reports, you just move the expenditure. So at the bottom of the financial 9130 report, there's a category that says, how much adult money did we spend on dislocated workers? And the dislocated workers is how much dislocated worker did we spend on adults? And that's where you would report that. So there's transfer. You can never transfer youth monies. They always stay in the youth funding stream, right? And then you can see at the bottom in the small little green box, a little small, but we only gave you, starting next year, and next week, you're only going to get 19% of adult and 21% of dislocated worker funds, right? As opposed to 1/4. We used to give you 1/4 because it was a quarter of time and then 3/4 in October. But now they've cut it back because that's sort of, they squeeze. And what they do is we look at the cost reports. Congress looks at that June 30 cost report and says, we have all these funds out there. There's obligations, but there's low expenditures. People are not accruing, and that's what we think it is. They're not accruing. So they just say, we don't have to release that much money because you're sitting on all this money already. Your report says it, right? So that's why they're only releasing. It also lowered, and that was a gimmick way back to sort of reduce the budget deficit. When Clinton was trying to balance the budget, he says, if we squeeze that 1/4 by September 30th, it's a smaller deficit, right? And then they released the rest in September. The only problem is you're enrolling people in training and so forth. That's the time of year in summertime when you're putting people in classrooms, right? Starting in September and whatnot, and you don't have the money yet, right? and you can't use future money. So it makes it difficult to operate for some of these categories. Again, we talked about transfers. And again, you know, you don't move the money. You just move the expenditure when you're doing transfers and so forth. Reallotment, we talked about this. We go through, we hold it back. You got to obligate 80%. We consider adult and youth already obligated at that level. It's really dislocated worker that's lagging because you have this 25%. We take the administrative, when we do that, we look at the administrative dollars, we give them credit for spending those monies, so it becomes now 65%, and then they have to obligate another 15%, right? And we use that June 30th report that you file, the state files. We look at that, we give the chance the state to be sure they're capturing all their obligations, and around December, we say, okay, here's the final number, and then starting in the new year, in January, usually we then go through and take the money from the states out of their new current obligation when they get new monies. How do you do that? Push more money down to the local area and dislocated worker. But once you push it down, you can't pull it up, so you got to think about that. But do you really need to hold back 25%? You know, we have a lot of data. You can look at the history of your reports, or the state can look at the history of their reports and see how much do we really spend a year in rapid response? What's that roughly amount? And maybe hold back just a little more than that, unless you think there's going to be a big change, right? So maybe not hold back so much. That's one way to do it. Distribute more, you know, distribute more, the state then doesn't lose that money. And the state, with statewide dollars, they can obligate, they can use their money statewide for specific unique projects. Statewide activities has a whole list of things you can do. The state can say, we're going to do some dislocated worker projects in these two areas because there's a need for it with this client group or this participant group. We want to serve this group that's been laid off or so forth. So you can do things like that. Yeah, okay, and we talked about this at the bottom one, just so you know. Also, just so you know, the slides, I don't know if you do the code, you can get all the slides, so I don't know if you know that, but that's why that's there. You can get everything, all the handouts and everything is in that code, QR code. Everything's a QR code now, isn't it? I went to park, QR code, you know. Pretty soon we're going to have them as like tattoos, you know, just put your hand out. What? The QR. That's a good one. So what are some of the a couple other funding requirements? You know, when you're 9130, when you're doing 9130s, when your funds are fully expended, you're supposed to close that report no matter when it occurs. You don't have to wait to the end of the period of availability. You know, if it ends, if you spent the money sooner, you're supposed to close it. I know a lot of entities will hold it open because there's still maybe some adjustments, some things roll in, stuff like that. We don't make a big deal about it, but when we see a report, let's say coming in March, the March quarter, we see everything's fully spent and all that, we'll call the state and say, well, wait a minute, why aren't you marking this final? Because it's a completed report. It's every now and then. Biggest thing, report on an accrual basis. Accrual basis, you must report. So your accruals on your report should always be a larger amount than the amount of cash you've drawn. Because you're always paying after the fact. You're recording the expenditure sooner, you're paying weeks later, a month later, whatnot. So you should always, and you can get the cash, you know, within 24 hours, you get cash. You draw it down, it's there the next day. I know now they've changed that, I understand, where ETA has to approve every cash draw by a grantee. I mean, that's just crazy. That is just totally crazy.
So have they issued a formal sort of fund, request for funds instrument? Do you have some written instructions on what you're supposed to be submitting now?
Yes.
So what do they call those? What do they call those? How much can you get without that review?
Nothing.
Nothing.
Everything.
So how do you pay your subs?
Late.
Oh. We don't?
No, they probably pay them late.
So are you guys having a problem getting your money that way? These are the subs.
How often do you draw? Every once a week, or do you draw very more frequently so you can get the money a little quicker, like every couple days, or what do you do? Where is her? Where is she? Request? Yeah. So do you have like a schedule, like once a week, every Friday we make a draw, or just, you know, like when you're drawing money for subs, they report to you, what, once a month? And then you make the draw right afterwards? Or? Right. Make a draw and then you get the money. So you're drawing a lot more regularly, I bet, now, since it's taking longer. Okay, that's what I thought, yeah. Okay.
That must have answered.
Yeah, that's going to be a real mess, I think, doing that business that way. Just more administration, you know, to go through more checks and whatnot. And we already have systems out there that do that. Again, you can only liquidate your obligations once the authority ends, so that's real important. As the grant's ending, you be sure you obligate everything you can, estimate everything you can. It's better to have a little over obligations, and then when you liquidate them, okay, you return money, you don't draw, you just draw what you need. But if you don't book it as an obligation, then you can't draw it later. You can't say, oh, I forgot this bill at year end. You can't adjust your report to account for that. You can pay states and local subs and all. You can pay for storage and audit costs. You can prepay for those, especially for direct grants that are just ending. If you have a direct grant that's 3-year youth build that's going to end, you can estimate and put in audit costs and storage fees to maintain those documents for 3 years and prepay for that. Okay. What? No, I said you have to obligate once you have your report, the last report when you're closing your thing. Once you obligate those funds, you can't go back in, and we can't open that. We have to have a good reason to open that report to let you obligate more monies. Yeah. But that's going to be after the fact.
Well, we were just talking about errors and omissions that are found. Even when you're truing up your books at the end of the year, you might find something. Something's out of whack. You look, and it is a legal liability, and you do owe someone for that, or your organization is owing money. You can request to revise your reporting document that you sent to, your reporting obligations that you sent to the Department of Labor. But the idea of doing it timely allows them to also give the money to others. So if the money hasn't been committed now or reallocated to someone, you might be able to get that money back. But we're not talking 10 years later. It used to be like a 5-year rule, okay?
If you don't even get that, you get 1 quarter. Because if the report's closed, you got 90 days
After
to
it
close
locks, you can ask to have it locked with the valid reason, and it's the grant officer's decision to honor that. But you have to make it real and explain. And they used to be very amenable to that if they had the money.
Those days are over, I think. Because we used to open reports all the time, and then they said, no, you can open just your last report. That's it, basically. You'd have to have a real good reason even to do that. So they figure, you need to book it. So it's always better to, maybe you're estimating your accruals, estimate them a little higher, just to be sure, So again, here's the report. We talked about this. Is just a nice cross-reference, because a lot of time, it took me about 2 or 3 years to understand the PYFY 1 plus 2, the 85%. And of course, in JTPA, it was a lot different. It was even worse. This is sort of simplified, but we have the advance and the regular funding, and we call it the FY advance because it's a year in advance. Like, for example, this October, we will be appropriating money for July of 26 and starting in 27. It's like a year and a half from now. So it talks about that, and it gives you just a really cross-reference on how much and so forth. And these are your actual dollars this year for the state they put in. I think the program PY25 TAGL came out with all the state allocations and so forth. Again, there's other little restrictions by each funding stream. So let's talk about this. For example, in the youth program, you have the 75% and 25% for out-of-school, in-school youth, right? You have to spend at least 75%. And that's subject to waiver. You know, a lot of states, I think 30 states have said they've asked for waivers to lower that down, because 75% is a high level to get for out-of-school youth. You know, they're trying to target people that have left school and so forth. You can spend up to 75% with a waiver for OJT, wage reimbursement on OJT, right? That allows you to do that. No more than 10% can be spent on performance contract strategies, and that's a unique type of contracting. And we'll talk about that a little bit, but not too much. No, that was created in WIOA, and nobody's really used that yet across the country. That's money you can pull aside to do these unique to serve unique populations, but once it's parked there, it can never go back to the funding stream. It has unlimited life, and you set up a plan. The state's got to approve the plan. There's a lot of technical guidance around setting one of these up, and it's got to be independently verified that you met the outcomes, that you release the money then. So there's no life there, but it never goes back. So it's lost from your allocation, you know, but it's out there. And, you know, if things don't work out, you can use it on another strategy, but it's got to stay in that pot. So that each of the funding streams lets you do that, but nobody has tried that yet, because they're just not sure how that's going to work, I guess.
You use that like when you come to the end of the fiscal year and then just like allocate that into the...
You can anytime, but there's a process to go through to actually set one of these up. You know, you have to get approval from the state and so forth, and you have to have, you know, outcomes. There's a whole little section of, you know, what's the performance outcome, what are you trying to achieve, and so forth. But yeah, you could do that, I guess, at the end, and then it just sits there until to do those strategies, right? And you pay only as you're paying on outcomes. You know, we want to get this person. It's very hard to serve. It may take a couple years to serve them, and at that point, you know, once we get that outcome, if it's completing a training or getting a job, then you would release the money to that service provider who did it. But yeah, I guess technically you could do that, yeah. So. Again, also, we talked about the stop loss in dislocated worker. You know, we have a stop loss, hold harmless and stop loss. The local areas will receive no less than 90% of their average of their prior 2 years, I think it is. Let's say prior, yeah, 2 preceding years. So you don't have a big drop off. We do that. Again, you got 75% for OJT. You can do 20% for incumbent worker training, right? So again, 75% of OJT. We talked about incumbent worker. You can also use 10% for transitional jobs, right? May use up to. Some of these are up to, or at least minimum, and then some are up to. No more than 10% can be spent on performance contracts. We talked about that. And then, what's this one say? It's most expensive. Right. Oh, and then if you have a dislocated worker grant, right? If you have a disaster, I don't know if you probably got a disaster grant for the fire that occurred, I presume, or no? Yeah. So that is, we can release money, but you have to have at least 70% of your dislocated worker funding obligated before we would release those disaster relief funds, right? So we want to be sure you're spending you got your formula here for dislocated worker, that can cover it, and then we release it. And we do that also, sometimes we fund those supplementally or incrementally. We give you so much up front to get going, and then we start adding more to it over as you show your expenditures and so forth. And then again, these all apply again on the adult program, okay? So that's good to know. So these are all categories on your 9130 that you report against. Questions so far? Quiet? Okay, good. Other requirements. So we delegate formula programs. We delegate authority to the governor for WIOA formula for WIOA, unemployment insurance, Wagner-Pizer, trade. We delegate authority to set rules to the governor. So we don't interfere with state policy. We say, you know, state's got a procurement policy, they got admin policies. You must follow those as a state. We don't say they have to conform to federal like guidance, but generally they do. You know, you have a procurement process and so forth, but we delegate that. So for example, like equipment and budget modification, we delegate that for the formula programs to the state. They can set a dollar level for whatever they want to do. So for example, DOL, when we have a direct grant, like a youth build, We say equipment is $10,000 or more. You have to get grant officer approval. The state, I think here it's $250, somebody told me. I mean, you could probably buy that clock, but nothing else in this room without getting approval, right? I mean, could you buy a chair or table? Probably not, you know? And it's 10,000, it's per unit. So you can buy, the federal government, if you had a direct grant, you could buy 30 computers if they all were $5,000, $6,000. We'd say that's supplies to us, right? Budget mods, there's also what's the level for budget modifications. We say it's 10% of your total grant award for a discretionary grant. Based on the total amount, you get 10%. You can move between the 10 line items, except for indirect. Indirect, you got to go to the grant officer, right? So you want to move money around. We say move money around. You can do as many budget mods as you want. The state, for your WIOA formula, it's what the governor says. So you may have a different policy or a smaller threshold. So we'd follow that for WIOA. So, you know, remember we have formula programs and then we have these discretionary grants. Discretionary grants, you're dealing directly with the federal government and the regional grant officer or the national grant officer for making modifications. Formula, well, it's up to the governor and the state office how they decide what those policies are. Subrecipients cannot earn or keep profit unless they are a commercial organization. So governmental entities, nonprofits, tribal organizations, educational cannot earn a profit on doing business with us. Everything must be done at a cost reimbursement basis. Commercial organization, private companies, they're out there, KRA, Maximus. You can have a subrecipient agreement with them and they may have a profit amount in there. And we'll talk more about that tomorrow in procurement. So they can keep that, but everybody else, its costs must equal what you get. You know, it's cost reimbursement only. Other requirements, we say for a program income, if you're earning some program income, you use the addition method. So that means you spend that money, spend more, and provide more services. Question? No, I wasn't sure you're ready. You're ready though, aren't you? Well, I can't even read these, they're sideways. And we say that anything excess revenue over cost is program income, right? So you may be running something, you're doing something, maybe you're charging a fee. Like for example, a lot of program income, they'll rent out their space. One-stop centers will rent out space to companies to do training, they'll do customized training, come in and use our computers, come in and use our resource room. You know, we want to do resumes, we want to upgrade our workers, so we'll bring in 10 of them and we can use training in there and we charge them a fee. You can do that, as long as you're not taking away from our program participants. You can do things like that. But then you got to spend that money, right? Interest income, we say you got to put your cash in an interest-bearing account. That helps pay some of your banking costs. But any interest above that, that's program income. And when you draw cash, you're supposed to take that into account. Take that into account or any rebates or refunds you receive before you draw cash, because you already have this other cash that's come back to you, you've earned. So you draw a little less cash, right? Admin costs, what's admin? We used to fight about this all the time in the old legislation. Admin is defined at that section in the law, 683.215. It's a list of all the admin activities. If it's one of those, you charge admin. If it's not, it's all program. Charge agreement to program, right? Even though program agreements will have admin in them, we don't look at that. We just say that's all program. We know every subrecipient agreement or subaward is going to have some admin costs in it because you got to do business, right? But we consider it's a program function, so it's all program. In the old days, if some of you remember JTPA, we counted every admin cost down to the very last subrecipient to meet the limit. So if you imagine a state, we'd have these states, you get 5%, and they'd say we're over a cap because a sub of a sub of a sub of a sub bought too many pencils, and it puts us over the cap. I mean, we'd go all the way down to look at every agreement and say, that's admin, let's roll it all up. It was a nightmare. State, you couldn't control how much you spent on admin because people are spending admin dollars, and we counted every penny against it. Now we just say, that's the definition at your level, right? Another prohibition, you cannot spend WIO money on the construction of, acquisition, or purchase of a building. Okay, capital improvements like that. Okay. You can do changes to your building. You know, if you look in the uniform guidance, there's a definition for renovations, there's a definition for modifications. You know, modification for ADA, things like that. Renovations, because you got to put a new heating system in. Repairs and maintenance. We don't consider those capital improvements because the definition of a capital improvement must extend the life of the building and must increase the value. So even though you're spending a lot of money, that may not increase the life. If we if we put in new flooring, it doesn't change the value of this building or the life of it. So it may be a lot of money, but it's not considered a capital improvement, right? We treat that separately. You may still have to go to the grant officer or go to the state depending on what monies you're using. For example, the state may have a policy say when you do these kind of things, we're going to you got to get their approval. Direct grant, we would approve it. Youth Build does construction. They remodel homes and so forth. So we look at what you're doing. You're buying this building. Or we have a direct grant that says, we got a building, but we got to do some wiring. We say, that's okay. How much? And we say, okay, yeah, we don't want to do too much because it's a 3-year grant. You know, we don't want to remodel buildings that we're not going to own in 3 years. But there's flexibility there. But that's not considered acquiring a building or buying a building or, you know, things like that. So that's a prohibition in WIOA, right? There is a thing, though, we do have buildings that we have equity in, right? And sometimes those buildings get sold. And those were in the old days when we built all the unemployment offices. We gave the states what was called REDAC money in the 50s, 1958. That was a great year, I must say, 1958. Just saying, just saying. 1958 was a really good year. Actually, the money was a little before this. I think it was in actually 56, but we gave a distribution. It was called REDAC. And that was money the Congress gave out to all the states. They all had a special amount. It was put into their trust fund, and they used that to build these buildings, these UI offices, right? And then over time, we said you could take your UI and ES grant to pay back that REDAC, and then you could use it again to build another building. So they did that over time. They built all the unemployment offices. It used to be everywhere. Every city and county had an unemployment office, right? I grew up in Detroit. You used to have the glass windows, you know, bulletproof windows and all that, and people lined up getting their unemployment checks, stuff like that. So then you paid back those buildings. Well, when we used our grant funds, that gave DOL equity in that building. So now we have an ownership. Okay, REDAC goes back into the trust fund and they could reuse it again, but only for UI activities. It's very restrictive dollars. So now the building gets sold and we get a cut of that. So we may own 40% and the unemployment system may own 20%, and sometimes states use their state money. They use state bonds and things like that, state grant funds. So we have the three sort of entities may have equity in this building. When it's sold, we all get our cut, right? REDAC, the REDAC amount, if there's any remaining REDAC equity, that goes back into the trust fund, right? And can be used again. DOL says you keep the money at the state, you can use it on the 3 programs, WIOA, Wagner-Pizer, or unemployment insurance. You can spend it just like any other allowable cost. State money goes back to the state. Their percent just goes back to their state general revenue, right? They may have used what's called penalty and interest funds to fund some of these buildings. So that's what we do there. And the thing is with proceeds, they're not considered grant funds. They're just money back to you, and there's no life to those funds. You only report those, and this would be at the state level, you only report those when they're expended. So they're sort of unlimited life. Okay, so far so good? Everybody's got enough coffee? Cool. Do you have any REDAC? I think you have 1 or 2 here. A couple still. Might be, usually they're headquarters. It ended? You don't have any? I'm not sure, yeah. You know, and we've been very flexible over the years. We've allowed, states have moved equity. They said, you know, we got all these offices, we want to sell them. You know, a lot of states have gotten completely out of the unemployment insurance office, right? Except for their headquarters. So we've moved equity into the headquarters. We go through a complicated transfer, move equity here. We give our equity up for state equity and things like that so they can consolidate it here because they know there's always going to be this main court office where then their offices out there, they can rent and lease and close them or open them or move them whenever they need to. So a lot of states have done it. Michigan, they did that. They got rid of all their offices. Ohio got rid of most of their offices, and they moved the equity around into their headquarters because they know it's always going to be there. You know, and then they got those, frees up those proceeds. Prior to, I think, 2007, we used to have to give the money back to the federal government. And then the secretary came out and said, no, we're going to let them keep the money. They're sort of their buildings, and now they can keep the proceeds. Well, when I was in Chicago, I had Ohio as my state. They must have sold 15 buildings, and all the money came back to us. And then, of course, the law changed, and they were very upset because they gave us tons of money. And now they could keep it. Like, well, we sold them already. So what's the deal there? Prohibitions, these are in the WIOA Act and in the regulations, things you cannot do with WIOA money. No employment generating or economic development. So you cannot use our money to start a business, you know, fund startups, things like that. You cannot do any of that stuff. Incumbent worker training funds for economic development. So you can't offer our money to entice somebody to come here and build a plant. You can say, well, if you locate here, we'll give you some training money when you hire the new workers. We'll train them for you. Now you can train them, but you can't make it as part of the deal. Indiana did this years ago. They enticed United to open a hub in Indianapolis and committed $1 million in JTPA money, and it was all disallowed because you're not allowed to do that. You know, you can't just, because all these states could say, well, we got money, California's got a lot of money, we owe money, we'll have you come move here, we'll give you even more. You can do it with state dollars, but you can't do it with the federal government. Public service employment, right? We know what that is. That's where you cannot just pay people to work. You know, we used to pay people, summer youth programs, just pay them to paint fire hydrants, do this, do that, clean up the park. You can't do that. That was sort of an employment that was done in CETA, which is way, way even before my time. Maybe back to Macy's time, but not mine. But, you know, we paid people to work. We just employed people because it was tough times. You employ people. You know, we talked about that. I almost did this during pandemic when people were losing their jobs. Like, why don't we just pay people to work for a year or two to give them some income till things turn around, right? Can't give any money to debarred or suspended entities. So when you give out a subaward, be sure you check, or a contract, be sure you check the list, the SAM list. You cannot award funds. We've seen that happen before. We've seen monies go to entities that were debarred because they didn't check the list. People that were debarred, they gave money to they were the director of a thing, we still gave them money. We stopped that. This is the one I hate, no foreign travel. Can't go anywhere. What?
Can I talk about the public?
Yeah, sure. Use your mic. Pull it.
I don't conflict with you. Can you hear me? For the public service employment piece, that's employment. That doesn't mean you can't have a trainee in the public service.
Right, that's right.
Just want to make that clear,
That's
okay?
right. That's right. So you can do OJTs. Right, that's right. Work experience, right, all those things, you can do that, right. You just can't, in the old days, we just had, like, for example, summer youth, we just employ everybody and just say, let's put people to work and pay them. You know, there was no curriculum or anything around it. It was just really just work to keep them employed. So you can't do that anymore. You know, and I think that's a big change. I don't know if, you know, I think it was during Bush's term, we did away with the summer youth program. You know, we used to have $1 billion in summer youth program. And we, you know, every year we added more. You had to do a little more academic things and 4 hours of academic, 4 hours of work. And it really put a lot of people to work. Students, you know, young kids that, you know, they're the only breadwinner in their families, their first time there. And we did away with that. And I think you see over those 20 years what's happened. Youth are unemployed. You have higher rates. No work experience. They'd have work experience when they maybe graduated. You can see that they work somewhere. It's really changed the dynamic of our country. You know, I mean, you have youth that they're not hired. They're hard to find. These are hard to serve youth to begin with. And who's hiring them? You know, we say, oh, the states will do. They don't have that kind of money. I mean, it would really be nice if they brought that back. And your allocations aren't enough. You can run a small program and maybe the state, but the states aren't going to pony up the money for it. We look for corporations, but it was really nice when they had that, and they did away with it for some reason. I don't know why, but. Well, there's always things like that. I mean, there's always scams in every kind of business we've done. Sure, yeah, it might have been fake students, or what it used to be, what were they doing? And then we started adding things. Well, let's do some curriculum training to them. Let's provide them some skills. Let's do some other things, train them a little bit before they go to work and so forth. So it's changed over time, but you know, they were run by the states in the local areas just like any other program. So we'd expect you to monitor that and people were eligible and all that. But it's really changed because now you have the out of school and in school. You have those funds, but it's hard for you to find them, right? They'll come in, they don't want to go through training. They want a job or something right away, you know, and it's hard to do. You got to place them. So they're hard to serve to begin with, right? Couple other things, prohibition against sectarian activities. So you cannot do any of that. You can work with faith-based organizations to do job training related allowable activities, but you can't proselytize. I can't pronounce that word. That's it. You can't work on the churchy or the place like that. So you can't do that. That's a prohibition. You can't use our money to encourage businesses to relocate. That's what happened in Indianapolis. You can't use our participants to displace employed workers. Let's lay off our workers, or they go out on strike, and we'll just bring in job trainees and so forth to get going. So you can't impair bargaining agreements. You can't hire people if they have layoffs and RIFs. You can't put OJTs with those corporations if they have layoffs or those entities. You can't do any of that. And then our favorite is the salary limitation, that we're all handicapped by this, right? We're all pushing up against that. Executive level 2, 225, yeah. That would be, this is what the Assistant Secretary of Labor gets, I think. That's it, that's their level. I think they're executive level 2. Okay, so let's talk about some of the other, I wanted to point out some of the other guidance we have out there that's related to fiscal training. Just so you're aware of, I mean, there's a lot, trying to find things, there's a lot of guidance in the system. You can look and like, where would I find this? What do I look for? Of course, you can always use Google or search engines, but these just gives you a quick reference of the key ones. We have 1110 FFATA reporting. Everybody hates that one because you got to report salaries on certain individuals and so forth. Reporting definitions. This is a really good guidance piece. It gives all the definitions, what's an obligation, what's an accrued expenditure, what's a liquidation of an obligation, things like that. ETA reporting, quarterly reporting instructions. We have revised reporting instructions because they've changed. We've got more reporting instructions because the form has changed and so forth. And I believe the 9130 is going to be going away. I think that's been coming for, I think, the last 6, 7 years they've been talking about it. But they're talking about doing away with that and making a more simplified standard report. The problem is on our report, we have all these little line items that you report on, and they may do away with that. You know, like transfer expenditures, all those kind of things in school, out of school. They may just have a basic report that says cash, expenditures, what's left. You know, they want to sort of standardize this across everybody, and that doesn't always necessarily work. Other ones, we have what happens when you have grants that are developing curriculums or intellectual property. They get to keep it, what happens when it's created. You know, who owns that, who has rights to it. You know, if we pay an entity to develop something, the federal government always can use that any way they want. You may be able to charge others, non-federal government, a fee to use that and whatnot for licensing and things like that, but you cannot. We can use it anyway. We can put it out to everybody, or we can use it as we choose it. We never really do. I mean, we never take your curriculums that you develop and say, we'll just say here they are in the commons for everybody if they want to use them. Again, implementing the salary limitations and so forth, how they apply that. The big one I like is the fraud, waste, fraud, and abuse. We've heard a lot about that lately, right? With DOGE. What do you do when you think there's waste, fraud, or abuse? What's the rule? What do? You call somebody, you call ETA? What do? You file an incident report, right? You all aware of that incident report? It's a form you fill out, you put down what you know about it, you send it in, or you can call the OIG hotline and report it. That goes up to OIG, they look at it. They may take that on and investigate it if they think that it's something there, or they'll kick it back to the regional office and say, go investigate this. And then we go out and investigate it, and we have to report back to the OIG what we're finding. As we're getting information, we say, yeah, it looks pretty bad, or we say, nah, doesn't look, it might be just sour grade, it doesn't look like it's fraud. It might be, might be not a great management decision or this, but it's not waste and it's not abuse. So we have to make some judgment of it. But we have to report back to OIG on every one of these. Every year we have to say, did we close them? What happened? Some turn into big things. Some are very minor and turn into big, big frauds. I mean, very big frauds.
So Tom, if we reported something to OIG and we never heard anything back from them, does that mean it's okay?
No, well, I mean, they may not get back to you and say, we don't ever get back to you and say, this is what we found. If it turns out to be something big, you may read about it in the paper down the road, but we never go back to you. We may call you and say, we need a little more information. We try to keep you confidential, and so forth, and say, you've shared this with us, and, is there any more? Can you provide us? But we never go back to you and say, this is what happened. We investigate, and then ETA or OIG makes a determination to say, we're going to take further action, or we'll tell the state, you got to go in and do something about it. Sometimes we'll tell them to go and do something about it and fix it, or we'll step in, question costs, stuff like that. But we never really go back to you and say, here's the result of it. I mean, I want to say sometimes FPOs may contact you and say, this is what's happened, but they won't give you too many details, just depending. We may just close it out, and we just don't think there was enough there to. It doesn't fall under those three categories, you know? Are you waiting to hear from something, or no?
Yeah.
We are.
Been a while.
It's been a while? Okay. Well, we can talk later outside. Turn that off. Yes, there's been an updated TIO. That's right. Yep, that's right. They revised, I think they have the form and whatnot, put it back out again. Again, we have one on 1514 about, we're adopting uniform guidance. That went out to everybody. It says you all have to follow it and so forth. And we've done that every time it's been revised. Here's the new uniform guidance. Big thing is also we have this one on making high-risk determinations for awards. So that's going to talk a little bit more in procurement. We talk about picking your subrecipients, right? Uniform guidance, in the past, we've always said you got to procure everything, every sub. We're not talking commercial buying of paper and whatnot and those things. We're talking about program work. You have to procure everything. And that came about from every time there was some big scandal, Congress would revise our laws and said you got to be tougher. That's why we have a lot of these requirements. And we're probably the only agency that have all these really tough fiscal requirements. Every category, cash management, this and this and this. We do monitoring, we do all these things because of things that have happened for some reason. But Uniform Guidance came out and said, you can select your subrecipients. Unless your current policies say you got to procure things, you can select your subrecipients, but there's a process you go through. You got to do a risk assessment. You got to determine if they're capable and all these things. And we'll talk about that in procurement, the specifics. But you can actually select them. You do not have to procure them. Unless your policy says, your board says, no, we want you to procure everything, or we set a dollar limit, or the state says, no, we want you to procure everything. So a lot of local areas have adjusted their policies to adopt uniform guidance that says, we're going to select our subrecipients. Because ultimately, no matter who you select, we're going to hold you accountable. You're the recipient, we hold the state accountable, the state holds you accountable, you how to hold your subs accountable. If there's any mess up along the way, we go to the state and say, give us the money back. They would go to you, give us the money back, go to them, give us the money back. But we're going to go to the state and say, you got to pay it back. That's part of the process. If it's a direct grantee, we would just go to you and say, you picked them, they failed, or whatever, it was fraud or blah, 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 disallowed cost. You got to pay the money back.
Tom,
Yes.
Carol is mentioned in a TIGL that's later. What was that TIGL you're talking about?
Incident report's been updated.
Incident reports, but she also has her hand up.
Don't we have to follow state or county procurement laws regarding the selection of the subrecipient?
Well, the state can pass on requirement. So if they've passed on saying you got to procure everything, you have to do that. If not, you'd follow your local policies. So your local policy, what does that call for? You'd have to change that, or you follow what they say. But the state can also say, we still want everybody to procure everything. That's an issue we have in certain states are saying, we're not changing, we want everything procured. A lot of states have said, no, we're going to get away from that. We're going to set a level, say you procure it if it's over a dollar amount, but you pick your subs. We're going to say, unless it's over 500 or something higher, then you got to go through a procurement. But prior to that, we're going to let you just pick your subs. So it's really what the policy and what the state does. The state can always imply, remember the state, as you pass money down, you can always add conditions to the sub below you. You can add reporting questions or things like that, different categories. You can always add that. So the state, I don't know, does the state have a policy that over everybody, or is it just at the state level here? Just state level. So they don't govern you now, right? The state tell you? So what's that? Do you have to procure everything? It's in the state, above 3,000. Above 5,000, you have to procure everything. So my advice is but what about competitive? That works for commercial buying. But what about it counts for everything? Anything, any grant or contract.
There's some exemptions in state law.
Yeah, if you're dealing with government, you don't have to procure them, right? But everybody else you have to procure.
But it's still following state law, but when it
Yep.
mentions it,
Right, that's right. So they'd have to change that policy.
I have a question. Are there any people in the room who get a direct grant from the Department of Labor, or does all your money come through the state?
Who's got direct grants? Youth Build, apprenticeship, prisoner reentry, earmark.
No direct grant from
None.
DOL?
Did you have them before and you just haven't been awarded any, or? No?
Just not applying for any? I wonder if city and
Maybe have
county
some.
has one.
Youth Build, yeah. So Youth Build, if you have Youth Build, you could, so you would deal with us for the Youth Build. So if you had direct grant, you could deal with that, based on what your county or your entity policies call for. You'd have to adjust your local. So I did training in another state, and they saw this is great. So they're going to their legislature and saying, you're handicapping us. You know, we want to up this, or at least up the dollar amount so we can start selecting these because we're allowed to do this, right? That's a big change. That's been a big change in our system. And we'll talk more about it tomorrow in procurement. But what I want to talk is this table talks about that process of making these risk awards. What you got to do when you're looking at a grantee to judge the risk, because it's really all about risk assessment when you're awarding money. I'm giving you money. What's my risk to me when I've given you the money? Do you have staff? Do you have a system? Do you have procedures? Can you do the work? Things like the performance, and those kind of things. Again, there's a few more. Pay per performance contract, as you mentioned this, Evan. There's a Teagle on that, 820. Again, the bonus limitation, award closeout instructions, allowable outreach activities. Report again, here's the updated training, oh, she left. 1523, reporting waste and fraud. Again, revisions to, we issued another one, revisions to the guidance that's coming out. Of course, they have to update 2900 in ours because there's a few changes there. I've gone through and looked at your state policies, and so we have also similar state policies that align with our training guidance letters. We have one on fraud, items of cost and selected items of cost and allowable costs. So you have a matrix on that, what's allowable, and so forth. You have a policy on salary and bonuses. Some of these may have to have dollar amounts adjusted because they're dated. Financial reporting forms for financial reporting to us, excuse me. Some more on transferring WIOA funds between the two categories, how you treat recapture and reallotment, or reallocation, closeout instructions. So far, so good? Okay, let's talk about some unique things. We get these questions all the time. I hope nobody brings up the one I didn't put on there as food. Let's just not talk about that at all right now, okay? Whoa. No, we're all gonna be hungry, but we're not talking about it. Let's talk about, we have incentive payments, we have stipends, supportive service payments, needs-related payments, retention bonuses I've heard lately come up, severance payments. What's the first thing? You have to have policies and procedures to address these areas, okay? You have to have policies spell out what you're doing, who you're serving, how much, what are the categories, or how you're going to judge it. Like, for example, supportive service can be a lot of things, so you can't list everything and say, if it's not on that list, we're not going to do it. But you have to have some parameters around that. And you can't create the parameter right when you want to do it. And I've had agencies call me and say, well, we want to pay severance payments. Do you have a policy? No, but our grant's ending and we want to give severance to the, you can't do that. It's got to be in your policy, not like the day before. So you got to look at your compensation policies and your program participant policies. Are you addressing these, right? Okay, we'll talk about each of them. Incentive payments. Usually incentive payments are for youth. They're not for adults, they're not for dislocated workers. Those we pay stipends. Incentives are like achievement payments or achievement things you can do with youth. They're tied to recognition, achievement directly tied to the training activities or the work experience, right? So you can give an incentive payment. Good attendance, the student is attending every day and not missing class, so you can give them a little incentive payment, $1 each week or $5 a week for all perfect attendance. Things like that because they're completing it. You have to have written policies and procedures to outline before you pay them. they're achieving credentials, work experience, training, so they're earning these things. And incentives, you can provide them both to in-school and out-of-school youth, as long as they comply with 2 CFR 200. So it's got to be an allowable cost, right? Can't be entertainment. That's real clear in the current recent issue training guidance. You cannot pay for entertainment type things. No sporting events, no movies, none of those things. That you can give them money or have a function when they all graduate, things like that, but you cannot. In the old days, we used to take them to baseball games and things like that. Of course, trying to go to a baseball game today is probably cost you $500 a person, right? No, I said in the old days, you can't take them to a sporting event. I said you can't do a sporting event, but I said, you can do cash incentives. And again, entertainment is unallowable, okay? Bummer. It's like I was telling mates, I said, well, you know, alcohol is unallowable, but if I just call it a refreshment, does it make it allowable, you know? So, and then, you know, this is always looked at. When we go out and do reviews, incentives, I mean, we know they're paid, but we'll look at how much and are you tracking them, are the people signing for them? I've seen, you know, we've seen a lot of abuse in here where they're giving kids incentive that none of the kids signed for it, that they received it. You know, things like that. So you got to have some really good policies around this of when they earn it, how you're going to do it, you know, who certifies it, how are you going to pay them. You know, we're not using cash anymore. We used to have petty cash. Those days are gone. You can't use cash anywhere. And I went to a place that's like, no cash, no cash. I tried to break a bill to tip the car guy, and he's like, nobody's got cash. You know, and they go to the bank, well, you're not a person of the bank, so we can't even break the $20 bill. I mean, it's great, you know, so now you're using what? Visa cards and all those things. So you got to really watch how that handles, right? But keep in mind, so that's for youth, right? Stipends are different. Stipends you can pay to adults and dislocated workers, and that's a little different. Stipends cover the cost of attending training due to lost wages, due to the time spent in training to ensure the person can stay in that training. You know, so it'll help them pay for things to go because they're not working. So you can say, we'll give you an incentive so much a week while you attend your class or so much per day because we want you to stay in that class and complete it. So you can do their fixed payments and so forth. And same thing, you have parameters around it, but you're paying that to the adults and VWs, paying incentives to the youth, right? So keep those terms separate. And that's important. We sort of blend terms. We say grant and contract. Contract is different than a grant. Grants are very flexible. That's why we use them. Contracts, you break a contract, you could face damages, right? The vendor could sue you for the balance of the contract. Grants, we just terminate and pay costs up to the date. We pay all the costs we've incurred. So be sure your terminology, you keep that consistent. You have grant awards, sub-grants, and so forth. We have contracts, subcontracts, and so forth. Those are two distinct set of rules that apply to each of them. Same with stipends and incentives. Stipends, again, you know, are incentive payments. Of course, we say and incentive. Difference between, keep track of that. Critically identify the payment types. Require documentation to avoid a disallowed cost. Be sure it was paid and should have been paid or wage should have been paid. They're also not taxable. The only thing that's taxable is wages. Stipends, incentives, support services are not taxable. Okay, OJTs are not taxable. That's training. So keep that in mind. We've seen entities want to tax things because it covers, you know, they put the FICA on there. They want to put a fee for the pension, the state pensions, and so you can't do that. These are non-taxable funds, right? Remember, wages are only taxable, so you can pay these. You don't give them a 1099 at the end of that. They've had so many incentives.
Sorry,
Sure.
Tom, and sorry
That's
everyone
okay.
for all the questions, but in your previous slide, it said the stipends are fixed payments.
Yeah, they're
Right.
like a set dollar amount.
So
like
that means
$2.
it doesn't matter how many hours they work or how many hours they train. The stipend is the same every week for the participants.
Yeah, that's right. I mean, you would base it on what they're doing, so you'd set it up like how many hours are going to be in it, and you pay them so much per day or so much a week.
And-
You make a judgment call on like how you want to pay that and how much.
And-
So,
And just to be clear, stipends are not taxable.
they're not taxable. You know, that's to keep them the thing. So they may use it to pay for driving there, may pay their gas, may pay other things that they need. It's just so they attend, you know. And you don't have to pay everybody a stipend. You know, you don't have to do it. It's you choose to do it, you know, so you have to set that policy of when you want to pay stipends, what funding source you're going to pay them with, why you're paying them, things like that. Usually dislocate worker, we usually don't pay them stipends too often because usually we're putting them in work experience or other OJTs and so forth. We usually do it to adults because they have absolutely no income. You know, they're low income, they have no income, so we're going to say, okay, we want you to attend this, but we know you don't have money, so we're going to give you a stipend for every day you attend, you know, to keep you in the class. But yes, they're non-taxable. And everything is always needs-based, right?
Yeah, I think the problem is with our state tax department.
Yeah, no,
Participants that.
they're not taxable. I mean, and there's IRS's issue, it's an old ruling, but I can try to dig it out, but IRS came out way back in the 80s and said this stuff is not taxable. So, yeah, so these are non-taxable. Yeah, I mean, states want to tax everything. They're like, let's tax it because, you know, it brings revenue into us. Good. Question back here, behind you.
If you're issued a 1099 with a stipend, you have to pay it.
Well, I mean, they should, who's issuing the 1099? You? You're issuing the stipend. How would the state issue a 1099 for your participant? How do they know?
Because they're paying a stipend.
The stipend comes from the state? It doesn't come from your office?
It's a state check, it's not my personal check.
No, I mean,
Participant, it's for the participants and for that, not just state is responsible, because the state, we operate separate.
you're at state level.
But county also does, like,
Well, county, cities, all the workforce boards and all that, all those subrecipients, they issue 1099s?
Yeah, they do, they are issued. But of course, we get participants say, well, if I knew I was gonna be taxed, I wouldn't have participated.
That's the point, right there. No, they're non-taxable. I mean, I'll dig it out. I'll dig it out and I'll send it to you guys. The IRS has said these are not taxable items. We have this battle sometimes of saying they're not taxable. You shouldn't be issuing 1099. Do you issue a 1099 when you put them in training? They pick an ITA, isn't that taxable? I mean, you could tax them on every little thing. And you could say, well, you got an ITA for $3,000 for college. We're going to tax that. That's you got $3,000 to pay for your college. It'd be the same argument.
In some cases, the stipends are used in lieu of wages for.
Ah,
Well, see, that's why I'm
That's
saying
why my
terminology. We have work experience. Wages are taxable. Work experience, that's wages. Stipends are not wages. That's right. And incentives are not earned income or wages. So that's why we're saying there's a distinction there. We're going to come down to that. But that's the thing. If you're paying wages, like OJTs, you pay OJT. Is that taxable? No, it's training. You're paying for training. So, I mean, that's the thing. You don't want to be taxing. Like you say, if they get taxed, they won't, why would they want to, they won't participate. And stipends cannot be used in lieu of wages so that you can avoid paying wages so they avoid the tax. So if they're in work experience, you can say, well, we'll just pay them a stipend instead of the work experience wage, and they won't have to pay tax. Wages are wages. So you can't, you know, play that game and let's call it something else. At the bottom, stipends cannot be used. Right there.
It's the wage and hour division.
Hold on one second. I think I got something here I brought with me. Where is it?
if it qualifies as work on the wage and hour, that's the test. And so I think there's a thin line between wages and stipends, and you cannot cross that line. Right, I'm saying, there's a thin line between what is
It's not a wage.
between what
It's not a
is a
wage.
wage and what is not a wage.
But it's, hold on, it's not a wage because you're not paying a minimum wage. Are you paying a minimum, you're paying prevailing rate as the stipend?
But still, you're doing it.
So, and what are they doing in that activity? Just attending, well, that's wages, and that work experience is wages. So you're paying an hourly, but if you're paying somebody $3 a day to attend a training class and you're issuing a 10, that's not a wage. Okay? Forms of payment for WIOA youth participants. Wages is a form of compensation employers provide. Wages must be paid, labor standards, as Macy said, all sorts minimum wage, 40 hours a week. Stipends, when an employee-employee relationship does not exist, a stipend may be used as an allowable payment for participation in training, blah, 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 blah. States have flexibility when how to pay stipends. However, most policies place payments on those stipends. Clear guidance is needed. They're not wages. So you either have a wage, you can pay them a wage, and that's taxable, but you can't count everything else like incentives and stipends and all this other stuff, supported service costs. Those are not wages. So that's it. So you got to be clear. I mean, you may be paying them a wage, and that's fine. If they're in work experience, that's a wage, right? So stipends. Let's say you have policy. We talked, there's a difference. Keep that clear. Be sure you identify the types so you don't have a disallowed cost. The funding source you're going to be using, be sure, you know, if you're paying incentive, you're using youth funds. If you're paying stipends, use, and only wages are taxable, right? Supportive services, right? So sometimes we call this programmed, I think in the uniform guidance they'll say participant support, I think is what it's titled. And that's a big, that's the top title of it all. Under that comes all these things, participant support, which are supportive services or stipends or incentive payments, all that stuff. That falls under the umbrella. When you look at the uniform guidance, it says, well, those aren't allowable. We say supportive services are allowable. They're not, we don't call them program participant costs. We call them supportive services. So you want to have policy, develop a policy of what you're going to pay, how much you're going to pay, how often you're going to pay, who's eligible, what you can support. You can do a lot of things with supportive services. Pay for a lot of things. Try to keep some limitation around how often you can do it, how often the person can keep getting that supportive services. Child care could be so long. You could pay them, you know, bus fare, gas things, all sorts of things. Fix their car, buy a new battery, all sorts of things. You provide how much to keep them in training, unable, they can't get it from anywhere else. It's like a last resort, so you're giving them that money. Pay for tools, shoes, transportation, all sorts of things. Just have your policies around it. A lot of places, it's one of the big areas. Nobody has policy around this. You know, we see a lot of abuse, and we look at this a lot because it's payment out to people. It's cash out to people. We want to know who's getting it. It's potential for fraud because you're dealing with cash and money. The area, I mean, we've disallowed costs because we didn't know who got the payments, who you paid, did they sign for them, what did they do with the money, you restricted, did they spend it how you wanted to, you know, and things like that. And because we're not using cash or checks, we're using these credit cards or other methods, it's hard to police, you know, to really watch what they're doing. So you want to have solid policies around it because this is always looked at, right? Again, in the regs, there's a very big list, but that's not the only list. It can be stuff besides that. It's what you determine that's good for you, your participants. Maybe the only type of support they get to meet their needs. You establish limits, supportive services. We talked about that. Be sure you have solid policies. We see. I mean, this is probably probably the second most written finding we write. First one is you don't accrue costs. Second one is probably not having policies around these categories and certain things. So far, so good. Needs-related payments. These are unique. Usually these are paid to dislocated workers to keep them in training after the unemployment check ends. They may be in a longer-term training program. So their unemployment is ended, and you can continue creating this needs-related payment that cannot be more than the unemployment amount they would have received till they complete training. But they're very costly to you as a budget. You know, they're a lot of money. When you're paying a check out every week to somebody who's in a 2-year training program, and you have 20 people there, that could be a lot of money. It could be $70,000, $80,000, $100,000. So it depends how big your grant is and what you're doing. Question?
Yeah.
Where'd it go? Where'd it go? Who's still? Oh, here, right here. Here's one. Here's one. I found one right here. Wait.
Could you just underscore I think the prior slide, that the local workforce boards are the one who need to establish a policy on the
Absolutely.
limits on supportive services.
Absolutely.
It's not a state.
That's right. This is not a state level. They can provide guidance around it, but locals have to have policies, and every subrecipient below that has to have a policy. So your local board, you may have policies, but then you're subbing out money, service providers, what is their policy, or what are you telling them they can do? So you need to have solid policies around this. Because technically, if you don't have policies, we could disallow it. ETA could disallow it, saying you paid this, what's your basis, how much? We know it's an allowable cost, but you have no policy around it.
Tom, on your next slide, I have a comment, question.
Okay.
Participant must be in training, enrolled in training for needs-based payments.
Yes.
I think there is some wording there, and we can check it later, that says they have been notified they would be in training. So if they've received the notification, though they haven't yet made it to the training, is written in the WIOA regs. Is anyone familiar with that? Carol, never heard of this? Mary Carr?
I haven't heard that. Say again? Yeah, they're very rare.
Oh, you don't meet the needs?
No, they don't pay.
You don't pay them?
They don't pay. These are very rare. These were mainly paid when you had big dislocated worker grants. There's a big mass layoff. People, 3,000 people. I was in Michigan, 5,000 people lose their job at General Motors. We're going to retrain them, but they got to go through 1, 2, 3 years training program. Well, the minute their unemployment check ends, they usually quit training and go find a job at lower pay.
Well, we may have a different situation.
So we said, you can keep paying them this needs-related payment to keep them in the training. It's sort of like the stipend. You're keeping them in the training, but these are
Yes.
based on an unemployment compensation amount. So that's a lot larger. You're maybe paying $300-400 a week based on family size and what is the average benefit here. You could see that. So it's really, they're very unique, and you'd have to have a big grant to cover these. I mean, you'd go through $3 million in half a year if you had 40, 50 people in there, because you're churning a lot of money. But it's just to point it out, because some people just, all the various activities you can do. Again, you must have policies prior to paying them. State should have policies. Dislocated workers not to exceed, they can't exceed the benefit level of a UI. Usually paid for dislocated and so forth. So we've talked and calculate and track them. Okay, what do we got here? Needs related. We've talked about this, there's a process, because I know we're going to be short of time. I don't want to take you into your break, but we don't want to kill this because you're not really doing it, so. Severance and retention payments. Yeah, right. No, it's not prohibited. That's what I'm saying. I want to point it out. It's a possibility and so forth. It just depends. I mean, you may have a small grant that you do it and so forth. Severance payments. Got to have a policy. Leave. How do you pay leave? Okay, annual leave, sick leave, whatever. 2 methods. Pay as you go. So you got to have money. Pay as you go. People leave and you owe them annual leave. They retire, whatever. You got to have money there to pay them. Or you set up an accrued system where you park the money every pay period. You put so much into a set account to pay for future leave payoffs, right? One or the other. You can't switch back and forth. You set up one, same with like pension benefits. You set up one system or the other, pay as you go or accrue it and park it in the bank. You set up a special account that then you tap that when somebody leaves to pay it for their leave and severance. And you have to have a severance. How much they get? So much per every year they worked and so more, things like that. So you have policy around that. Made to former, current employees, pay as you go, as I said that, right? Understand? What do you guys do? Do you do pay as you go? Somebody quits or retires or a grant ends. Usually we see this when a grant ends. Grant's ending, we got a direct grant, it's ending, our people are gonna be laid off, we wanna pay them severance. We go, you can't, you got a policy. No, we don't have a policy, we wanna pay them, well, then you can't do it. Like I said, you can't set the policy up yesterday to pay tomorrow's severance. We would question that. Let me go back one. And we had one too on retention. We had somebody call me and say, we had I don't know, the local area said, we want to pay, I think the state called me and said, they want to pay a retention bonus to people. They're losing people, there's a lot of turnover. We'd like to pay people a retention bonus because they're going to other places. And I'm like, well, and they were, they wrote in there saying, we have money left over, so we want to do that. So that was a big mistake because you're only doing it because you got the money. We may not have it next year, whatever, but I said, well, can't you give them a raise, give everybody a raise or whatnot? I said, you can probably do it, but you got to have a policy. If you don't have a policy, you can't do it. So you can probably do things like that, but it's got to be part of your compensation policy. So you want to go through that and see all these areas, like if we're going to do this and so forth. And then assuming you have the funds to do it with, okay? So it is allowable, required, but it should be part of your employment agreements and so forth. Internal controls. Be sure you document how you calculate payments, how you process the recipients receive the money. You can document this. We look at these. Credit cards are very common. You know, I did a review in a southern state, and we questioned about $6 million in their credit card payments. Disallowed all of it because they were just sending them out to everybody. Big fraud. We can be sure that we can show that the participant received the payment. You have separation of duties to control access to these cards. We also have other statutory requirements around 185, states and direct grant recipients, prior reporting requirements, OMB approved things, so keep that in mind. There's every now and then those come out with GAP and so forth. Other guidance around reporting, so forth, definition, these are important to remember and reference to. Basic reporting, you know, accrual, quarterly, due dates, it's in your book. There's a little cheat sheet on it, closeout. You got 120 days at the end. That's the new reporting, but it's not been adopted by ETA. You're still at 90 days, I think it is. The new uniform guidance says now you got 120 days, but DOL is not incorporated into the 2900. So you're still at 90 days, closeout. Online reporting. Again, we've talked about this. Program income, be sure you follow those. Be sure you're allocating your costs to the various things. Remember, you can combine admin, the 3 funding streams, you can combine it, and we don't have to say there's youth admin. It's just where you report it. So we say admin's admin, and you just put it in the category. The issues we usually have is reporting on accrual, cash exceeding expenditures. That shouldn't be the case. That means you're not accruing. Inaccurate reporting at the subrecipient or timely reporting. You know, inconsistent reporting. Reports have big negative amounts. Sometimes they change, or they're changing the report frequently, things like that. Underreporting of expenditures, late reporting, all those things. You probably see them now and then, so forth. So let's just real quick buzz through the 9130 report just to be clear on everything. We're going to talk about recipient share and match, federal funds, property proceeds, in-school audit, school youth, paper performance, unliquidated work experience, training expense. These are all unique little categories in the 9130 report that you would report against, right? Besides their overall total cost, total cash, things like that. Recipient share, match, cost sharing. Recipient share is different than match. Match is a requirement for certain direct grants like Youth Build, things like that. Recipient share is just non-federal funds are spent towards support of that project. So if you're spending county funds, state funds, we want you to record that, right? Other federal funds you're contributing, we want you to report that on that report so they can see the total cost of what you're spending on those programs besides the money we give you. We accept that it's got to be verifiable to records, especially for match. Cannot be included in other federal awards. We don't include that, so you can't count match across 3 or 4 grants. It's 1 grant at a time. It's got to be necessary and reasonable for the project. There got to be allowable costs under the uniform guidance as well as WIOA regulations, and are not paid with federal funds unless authorized by the grant. Well, there's no federal program except for I think the CBJT grants that can be used as match, community-based. Can't think of what those were, grants. They're small grants that go out to communities. They can count it, but no other federal funds count as match. So they've got to be non-federal funds. And we really look at match because we've seen a lot of funny things in there, a lot of abuse. If you miss your match amount, it's disallowed. We take money away from your overall grant. So whatever you miss it by, we're going to reduce your grant. You're going to have to pay us for that. We look at rates of pay for volunteer time. That's a big thing. Well, staff work and then they volunteer. And I've seen, I'm working for $15 an hour, but when I volunteer, it's $95 an hour. I've seen one grant where the person, when he added his work time, he was the director, he added his work time and his volunteer time, he was working 22 hours a day, 6 days a week. You know, and I talk to the guy, it's like, so you sleep, what, 2 hours a day? You know, you just work round the clock, right? And of course, paid at this amount, but the volunteer time was like double his rate of pay, you know, things like that. So we look at, this is really looked at more and more in the match because we've seen a lot of funky things here. Rates of pay should be comparable to labor market, shouldn't be excessive, should be the rate of pay you're paying a person. It can be the same as the match amount, but it can't be different. Fair market value is used when when people are donating things to you, buildings, equipment, vehicles, things like that. We use the fair market value of that, not the elevated price or what you want to put a price on it. We would look at fair market value, how you're basing, because a lot of the stuff is used, it's old, you're using it as match, so, and we'd use maybe depreciation to determine what that rate is. If it was bought new at this and it's fully depreciated, well, then there's no value to it unless you got a fair market value saying it's still worth a couple $100 or $1,000 or something like that. Like we said, volunteer service, what's the rate for similar work? Third-party contributions are valued at actual cost. So if you got entities that are donating money to you, we'd count that there. Donated real property cannot exceed the fair market value at donation, things like that. Value of land and real property, we'd use depreciation. Usually we don't count land. I mean, nobody's going to give you land for match. They'll give you a building. And then again, donated equipment can't exceed the fair market value, right? What is this? Again, we want you to report other things. You know, if you're getting money, and these are not matched, if TANF is giving you money, you're using it, using VETS, RSA money expended, your co-enrolling participant, we want you to record that as recipient share. Real property proceeds, we've talked about that. That's a line item only when they're expended. It can only be spent on those 3 big programs of ours. WIA does not have a match requirement. WIOA, I'm sorry, WIA. Boy, I wish they would change that. You know, can we come up with a new acronym? It took us about 5 years to get that into our acronym from. Again, out of school, in school youth. You report those are separate line items. Work experience, these are wages. Wages paid or stipends and some time work, employers, all that stuff that gets reported in that line item. 29 states have gotten waivers on the 75%. You're not one of them. So you should think about that if that's impacting you. Are you meeting the 75% or not? You may think the state should think, let's get a waiver. Reporting periods, we've talked about that. We look for complete, accurate levels of reporting throughout the last day of the quarterly report period. Your reports, the subrecipients get to you in time so they can roll them up at the state level. You want to give them a little tighter time frame to report to you so that the state can then fill out the report with us. They're always cumulative, cost to date. Each quarter, it's always cumulative cost, what you've spent. Again, you know, we have 13 versions of the 9130 report, isn't it? We've simplified it for you. I have that in the handout, so you have all these possible reports to file, right? And if you're a direct grantee, you would just have one with us. You'd have the basic 9130 grant. And each of them may have different categories. And as I said, they're going to change that. There's talk that they've been planning to do away with the 9130 report for a number of years, but I think it's coming sooner. It's getting real close where they want to just standardize it, but I don't know what we're going to do with all these categories that we have to report against. We'd have a separate report for that or something. Again, it's basic information. There's a cash section, expenditures. We track admin costs, unliquidated obligations, which means you can spend those monies somewhere else. We got recipient share. We got a program income section. And then we got all those additional data, expenditure elements, and then remarks if there's any issue. If you're FIFOing costs, if the state's FIFOing costs, you would put in the remarks, we move these monies back. And because sometimes we'll see a report where they have negative expenditures. How do you have negative expenditures? Well, you've taken it out of that report. You've moved it to an older cost report to expend those monies. We'd note that in the narrative. Stand-in costs. You know what who knows stand-in costs? It's costs when you're standing. Come on. How much money? That's a bad joke, isn't it? Accountants have the worst jokes, don't we? We have the worst jokes. So stand-in is a thing that was fought years ago. So you had an entity had a disallowance, and they challenged ETA in court. Now remember, you file we disallowed costs. The state appealed it. You go into court, they got to fight it with their monies, and they challenged that disallowance, and they brought forward saying we spent state monies on this program. Why can't we use those monies for the bad costs? And the judge said you can. The administrative law judge said yes, you can do that. It's going to be called stand-in. They said, back out those bad costs, and let's stand in these other non-federal costs to replace them. Because they were support of that program, they were allowable, they were the same participants, all that stuff. It would have been just like you ran the program, but they were non-federal funds. That's called stand-in. But there's rules around that. You got to report it. You report it in the narrative section. It's got to occur in the same time period. Has to serve allowable people. It's got to be allowable costs. So you report that, and it's got to be subject to audit. So we report it each quarter on your reports and whatever, and if there were a bad, and it's got to meet the limitations. So, you know, if it's admin costs or program costs, you stand in admin or program. You can't exceed the admin limit. So for example, I can't say we spent extra admin that we never charged to stand in because it would go over the 10% or the 5%, right? So you can stand them in. That's what's called stand-up, but you got to report it. Most places, and usually when you have a disallowance, one of the first things we say to you is like, can you write us a check? When are you going to write the check? And they say, well, no, we don't want to write a check. Well, you sure you got all your documents? Is there any documentation we did not see that would resolve these costs? We looked through it. We were very fair. We try to accept everything we can, maybe reduce the amount a bit. And then we say, okay, you want to write us a check now? And they're like, no, I don't want to write you a check. If you got stand-in, we will stand it in, and we'll resolve that bad cost. So we've done that. I've done that several times for, you know, big disallowances, as much as we can stand in and whatnot. But you got to be sure you're reporting it on your quarterly reports, right? And it's got to occur at your level. So the state can't say we have 5 workforce areas and we're going to count all their stand-in because the state misspent money. But the local area, you know, they may have several subrecipients. One local area may have several subrecipients. They might have stand-in from one and a bad expenditure from another. They can do that because it's at that local level, that one local level. So it stays at that level. Okay, so that's real important. But that's a real savior to a lot of programs, and that was accepted by the judges. I think it was in 1968. So again, non-formula programs. You know, information is pre-entered. Usually, we enter the amount of cash you draw. We got the amount of money we gave you, the obligational authority. We put that amount in. We put the amount of cash every quarter at that date. We cut off the cash system. Here's what you drew. And then you report your expenditures. Formula programs are a little different. Some of the data is pre-entered, but the rest, like cash, you know, we know what the big dollar amounts are of operational authority, what you gave each program, you know, adult, TW, but we don't know how you drew your cash, right? So the state has to move the cash around the meat because they draw a lump sum from WIOA. They have to then distinguish how much was it for adult, how much was for DW, how much for youth, and put it in the appropriate report. So there's a little distinction there. Again, we have the line items. We got federal funds authorized. You got federal share of expenditures, the admin amounts, unliquidated obligation, what's the remaining to be liquidated, what are total obligations, then the unobligated balance, right? Straightforward. I'm just going to zip through these real quick, unless you got questions. Federal share, remember, net share cannot exceed 10D. Federal funds, that's a hard edit. You can't go over the cash amount, or I'm sorry, the expenditure amount of what we've given you. Can't overexpend. Be sure your cash is net of refunds and rebates. You know, you want to take that all into account, program income, before you draw cash. Again, soft edit. Cash should be below your expenditure level. You accrue first, you draw cash secondary, right, to pay later. So expenditure should always be ahead of your cash. Unliquidated obligation, it's a sum of these, undelivered services and goods. You haven't received them yet, so you haven't liquidated them. You set up the obligation, you pay against it as you receive services. Total amount of obligations, which are accrued expenditures, have not yet been incurred, right? So straightforward, those are in the definitions also. Again, recipient share, we have recipient share, the share of those, what you use, what you've spent, what was unliquidated. It's the same for all these, straightforward. What's this one, recipient share? Same thing, unliquidated, it continues down. Oh, if that's a duplicate, what is that, same thing? J, oh, those are duplicate, I gotta get rid of that, that's a duplicate. Recipient share issues, leverage resources, that's where we put leverage. It's not a match required. Be sure when you're applying, sometimes this is discretionary grants, direct grants. You're saying, oh, we're gonna leverage these funds. Well, watch what you put in there, because if you put it in there, we're gonna hold you to it. Even though it's not a requirement, don't put in, oh, we're gonna leverage it for an extra $1 million, we sell this up, and then all of a sudden it's like, oh, well, you know, thinking that's gonna get you the grant award. Well, we're gonna hold you to that. You know, it's not a requirement, but we're gonna say, well, you didn't meet that and you said you would. That will be a ding against you next time you apply for a grant. Lack of documentation for in-kind contributions. You want to be sure you have some documentation that support the value of things you've donated and so forth. Again, stand-in costs, right? That's a big thing. Program income, same thing. How much you earned, how much you expended, what was left. Definition is at 200.80. If you look at the uniform guidance now, in the definitions, they've done away with the .80, .81 in the original version. Now they're all under 200. 200.1, and they have every definition alpha, because they were worried about as they created new definitions, they couldn't insert them alphabetically into the they'd have to change all the numbering. So they just said, let's just call it all 200.1, and every definition's in there. So we have some new definitions, and we'll talk about that, I think, later today. And states need to look at this program income, be sure they're spending it. Direct grantees must include program income earned and expended, right? Additional, we get all these other items, property, property proceeds expended, out-of-school youth, in-school youth, summer work, summer employment, things like that. So summer work, that would be wages. You're paying wages to students, working, or young participants, things like that. Those are wages. Again, real property proceeds can only be spent on those 3 programs. Reminder to be sure your subs, you're monitoring, you're collecting the information required for all the elements. A lot of times subs forget, though, we got to report on training, we forgot to report this, we report that. You want to pass all those requirements down to your subs below the workforce area, down to the sub-recipients, all the way down the chain. You may have different time frames. States may say, we want you every 2 weeks, once a month, whatever. Usually, subs report, or local workforce boards report what, monthly to the state? Which is fairly consistent, right? Monitor reports, we do, desk monitoring of those reports. We look at sometimes things pop up. DOL when I was in the region, we would take all those reports, dump them into a big database, and we'd do some analysis, and we'd try to project, like at 6 months at states based on their prior expenditures to date, that period, where they're gonna be in 6 months, are they gonna face recapture? So we'd contact states like in March and say, based on your spending, you're looking at, not obligating enough money, you're looking at not expending enough money, you better, the next report, you better bump it up or see what's going on, so that we look at that. We'd also look at if there's areas, are they gonna meet the out of school, in school, contact, all those things, we start doing analysis around and say, where are you at, so we get back to you. And then just, you stay on top of things. Data's incorrect, things like that, we fix it. Sometimes reports are quirky. Sometimes the system, I know, the system goes down. Everybody's filing reports on the last day, and you're talking, I don't know, we have 3,000 grants, 18 reports, or what is it, 42 reports, I think, for every grant. Think about how many thousands, like in our region, we'd have 900 and some ETA 9130 reports we'd have to review. And everybody's filing them on the same date. Of course, the system crashes. We have dated systems. You guys can probably talk many times, we can't get in, the system crashed, blah, 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 can we wait, It's like there's nothing we can do. We don't control it. They got to be in by that date. Don't wait till the last minute. We tell states, don't wait. Grantees, don't wait till the last minute. You could get money on June 30th. You got to file a report. You get $1 on June 30th, you got to file a quarterly report. You can't say, well, I didn't get, even if it's zero, you got to file a report and say, I didn't spend any money. So you got to do that. Some forget they even have to file reports at all. Like what report? And last minute, we don't have a password, we don't have a PIN, can't draw our cash. It's probably 5 every quarter is like that. Who's got the PIN? They retired, they left it, there's no backup, we don't know what to do, and we'd have to go in and do all the paperwork to get the person a PIN and password again, all those kind of things, right? A lot of resources available to you. There's the ETA core guide that's just been updated, should be coming out any day or fairly soon. They're working on the financial management tag. There's smart training modules. How many of you gone through smart training? Come on, you guys have trained a few of you 5 years ago. I saw a few of you, right? You can always call your regional grant officer. If you're not sure about something, call them, say, we want to spend money, we're thinking of doing this. Is that okay? Are we violating anything? Something that are just a little different, not traditional. So we'd say, yeah, if you're going to do it, you can't do it this way, but you can do it this way, like we say, don't call it a wage. It's a stipend. It's a stipend or incentive. You know, this is what you do. So, and then there's like the workforce GPS webinars, but I've heard that system's down. I'm not sure. Things have changed since the new administration. A lot of these things are being looked at, these systems. Questions? Sure. Here. Okay.
Mic test. Thank you for providing a lot of the worst case scenarios type of thing. But if we go to the other spectrum, which is best practice, if a subrecipient or a local board, what are some of the resources that they can draw upon so they know what best practices are? Like, as you were saying, you know, don't wait until the last minute, but the other way is also to plan ahead, right? So that then, you know, 3 months or 2 months before the end of the cycle, the program year, this is the things that you might want to consider, meet with subrecipients,
Sure.
go over a
Sure.
checklist. Is there any resource like that that people can avail of?
Yeah, one is, you know, in your booklet, we have that resource in the back, the ETA, there's a guidance, several pages, you know, checking on subs, how well they're managed. One thing is, like, for example, if you're picking a sub or awarding a grant, you know, doing some pre-analysis of that entity. You know, they have people in place, internal controls, you do all that stuff to be sure they're capable of delivering that program, right? And monitoring's a big area, doing monitoring regularly, you can see when something pops up as a problem. You know, either reports are late, reports don't look accurate. There's all these little things, because as much as I like to say, you know, this is very our work is straightforward. It's cash in, cash out. You can pay for certain things, other things you can't. You know, and it's straightforward. We go out and I do a review. I'd say, okay, here's your last quarterly report on this date. You should be real easily to be able to produce a general ledger listing that shows me that amount of expenditures and a crosswalk for accruals. Straightforward. You know, you booked it. Where did that number come from? It should come from a system or a spreadsheet or something, right? If it doesn't, there's a problem. Categories, you know, you're coding costs properly. So it's straightforward type work. The other thing is states have done is, do you guys have any kind of regular meeting with your fiscal folks in all the workforce areas?
Coordination meeting monthly that
Monthly.
we've started maybe 2 months ago.
Okay.
And we talk about fiscal performance,
Okay.
but not necessarily with the fiscal folks. So I don't
Okay.
know whether the local
So
areas are doing
that's
it.
a thing a lot of states, when I was in Region 5, they did. We used to have a annual financial managers roundtable. We'd bring in the state financial managers from UI, Wagner Pizer, and WIOA, and we talk about issues. We'd do our monitoring, say, these are our top 5 findings of all these states and all the local, and we'd have them talk. We'd have them present subjects. What do you want to talk about? So we'd do that. Also, states would then go to their local areas and say, let's have a quarterly meeting of the financial managers. You know, I provided a list of reports here of where the major areas are findings, and let's make that a topic area. Why are we not accruing? And let others talk about what are they doing? How do they accrue their costs? How do they report them? How do they track them? Things like, and we take topics and do that, have them present topics. We'd also have some of them present. You know, if they've had a thing where they've done real well, they'd contact us. You know, I had a managing out, and this is dated, so things have changed a lot. But, you know, when we had big trade monies, did you guys ever get a lot of big trade money? We had big trade money in the Midwest, right? Well, this workforce area went to a bank, and they set up an online system with the bank with a credit card, with a debit card, that they could obligate money to the people in trade to pay for the classrooms, right? Pay for their class training, their books and supplies. It was all automated. The local area could put the money on the card instantly. And we're talking big money. They're talking, you know, they're getting $8-10 million because it's a big layoff. It's affecting a lot of people. It's a metropolitan area of a big city. But they could put, you know, and we were always like, you know, you're managing 3,000 people in training, and you're paying them needs-related payments on this side with unemployment monies. And on this side, you got all these people signing up for training and obligating the money. And, you know, you can't do that with a spreadsheet. It's very difficult. And we'd see the reports, they'd have like tons of money obligated, but nobody knew like the expenditure sides were coming. Well, they went to the bank and they put it right on their debit card. Person would get a debit card, they'd go to the class, sign up, pay for all their stuff. The cards were restricted, you know, and they could put the money on there, and the minute the drop dead date of training, they could take the money off. Any excess money, if it wasn't as much, they zipped it off the card and they could use it to obligate for other people. Real easy way to manage. They could produce reports. they could, you know, they could say, at this money, all the money's off the cards. You know, then next quarter we put so much money on them because they met with their case manager and said, you know, I'm taking the next class. But they'd have things like that. We'd have them present, saying, you know, that's a great way. It's a great system. Banks are willing to do it. They charge a fee per card, things like that. So that's an opportunity. You know, and DOL has gotten away from that. We used to have bi-regional roundtables. We've sort of gotten away because now we can't, you know, can't travel, can't have conferences, all that kind of stuff. You know, and so we rely on the states. And even us, we can't go out. It was very difficult for us to go out and present at your conferences, which was always very beneficial, you know. I mean, it's starting to come around now where states are holding and we can go out, you know, they'll let limited, but I don't know if that's going to happen under this administration. But prior, you know, they cut back travel so much. But there's areas like that. And we try to, when we have best practice, we try to share it with the fiscal folks in those regional offices to those states and locals. So there are, but the other thing is reach out to the FPO and the grant officer. You know, grant officer makes a call on a lot of these decisions. FPOs don't have the authority, but you know, if they usually, if it's something complicated, they'll tell me and say, you know, so-and-so called me, can you talk to them? And I think I'll call them. You know, we want to be sure it's done right, because when it's in the newspapers, they come to us too. You know, they say, you know, this is your program. What are you doing about it? How did this happen? You know, we would always, in Chicago, you'd open the paper and you know, every week there was some kind of big fraud. And we'd all be like, is this our program? Is this our program? You know, job training, we'd be like, thank God it's a state program. Thank God it's a state program, you know? But there, you know, you'd have that. When the money's where the money is. You know, when you have a lot of money, potentially you could, for fraud, because there's a lot of money. If it's small money, you know, not a lot, it's hard to steal a small amount of money because it's very noticeable. I'm just being very frank. We've seen all sorts, Macy and I can talk about all sorts of scandals. But that's it, you know, the thing is, we want to be sure the system operates correctly because it reflects all of us down. It's not us got you. We want to be sure you're doing it right so the system can improve and it doesn't get shut down. So we're on the same side here. As much as we come out, we're monitoring you to be sure it's done right and trying to provide TA right then and there. You know, if we can fix it when we're on site, let's fix it. It's not like, oh, I found it, I got to still, some things we still may have to write up and we'll say they were fixed on site. And then we're not talking like disallowances and stuff, real bad things. You know, minor stuff, we'll say, well, fix it. You know, remove it, use other non-federal funds to do that, things like that. But that's the goal. We try to provide TA. We also use, when we find, we go through all our monitoring reports, or putting in the system, the findings, and we sort them and we categorize them and say, this seems to be the #1 finding. Why? Let's start providing TA around that topic. Why is accrual? So we go out, we do a training program, we provide some TA to the state, provide them some training modules, maybe give them examples, case studies, and say, you know, here's what we're seeing. You know, let's get this back out there because everybody's doing it, and then have the state go to their local areas and do it. So we do that too also, look at where are the issues, right?
And I think you also mentioned seeking support from other states as well.
Yeah, absolutely, yeah. Absolutely. You know, people ask me, where is a good, you know, everything's online now. You want procedures? Google procedures. You'll get every state in the country. You can look, paste, and copy. You know, that's the best thing you can do. But, you know, we go to other states. What are you doing about this? You know, relationship with states. Now, you're a little different because you're a little far removed, but certainly you can call similar size states that are your size of funding and say, how do you deal with this issue? How do you deal with this issue? You know, states will work together. They build a relationship, the financial managers, and work together on things. So, and we've also, when we've done projects, we've tried to bring the stakeholders in on projects. Like when we did the tag, the one-stop tag and all that stuff, we brought in local people and state people to help work on those work groups because they can point out things that we don't see. You know, when I would do reviews, you know, sometimes you go to the state, people are like, well, let's go to the state, just review the state because they're responsible for the local area. Well, you know, you do a state review, how much money are we talking? 15%. 5% for admin. What are you going to find when you look at admin? I mean, what do you think you see? Payroll. You're going to dig in the payroll till you're blue in the face, right? You want to look at timesheet. Payroll's payroll. There's systems, there's controls around all that at a state. States have tons of controls, right? This is probably one binder of thousands that you have governing you, right? Every procedure, every policy, everything in there, there's no action there. Even statewide, there's no action. It's 10%. Where's the money? It's at the local area. That's where I go. I go to the local area and go out to the subrecipients. Go to your local area. I want to go to the street to see the program, who's being served, how they're spending the money, because that's where the action is. That's the same thing. That's where you learn. That's where you learn, well, this works here. This is a small little sub. They're doing a great job with a hard-to-serve client. This needs to be shared. And that's what we try to bring back and share. So, questions?